I think what's really going on is major asset managers, hedge fund managers, mutual fund managers who've been around a while, have some experience and haven't forgotten the last 10, 20 years, and gotten all gleeful because of the stock market. They're somewhat suspicious of what they see in the stock market. There's all kinds of valuations that just don't make sense. The longevity of the market doesn't make sense. The steepness, the recent steepness scares them because it's blow-off type action, and blow-offs end very badly the other way. So I think there's some smart money out there that's saying, hey, I'm not going to get out of the stock market, but I'm going to shift some money out. 5% here, 5% there. And I think what they're doing is it's moving into those asset categories, safety of T-bonds and gold and silver. I think that's why those two markets are moving in sync right now. Don't expect it to continue. Because ultimately, yes, the T-bonds will go down in price, up in yields, because if inflation persists, which we think it will, then you will suffer if you're long the T-bonds. I frankly think we're topping right now. And I have been thinking that we're in a topping process for several months now. That doesn't mean it can't go up. I mean, you're up until you're down, right? Joe Granville said that. But we have numbers below the markets, both on the NASDAQ 100, which is our leader index. There's no question it's been the leader. It's outperformed everything. The top 5-6 stocks in the NASDAQ 100 constitute over 50% of its weighting. We all know those symbols: Amazon, Apple, Microsoft, Google, etc. They also constitute probably about 25% of the weighting of the S&P 500. So as these indexes have moved up, it's not because of all the symbols within the index. It's primarily because of the leadership has been so strong. And therefore, focus on the NASDAQ 100 because that's where the leadership is really weighted. We see numbers below the S&P and below the NASDAQ 100 that aren't that far down there. Now, considering that we've had a dozen-year uptrend, which is highly unusual, and a lot of that's been vertical, it's scary. And it's scary because if you're a price guy and you're looking at, let's say, a weekly or monthly price chart of the S&P or the NASDAQ 100, and you look at your screen, try to define where you think it breaks. Try to draw a trend line. It's almost impossible. Whereas you might draw one and then it goes up at a steeper angle, we have to draw it again at a steeper angle. It's like multiple lines. So there's no line that touches 3 points. It's just a curve. The problem for the price chart technician at this point in time is when you turn down, there's no consensus as to where, oops, it broke something. And when you don't have a sense of, where you are on the map, emotions can take over, panic can ensue. So it's going to be an interesting game this year. There's a lot of stuff's going to happen this year, not just the beginning of stuff, but actually the culmination of many of these turns. We try to put blinders on. I mentioned that I saw the front page of the Journal today, but I don't try to pay attention to what other people think or what other factors might be in play here. There are major factors in play, big fundamentals in play. We all know that. In our last weekend report, we had a Fed funds rate chart going back like 30 years. I mean, you just look at the silly thing and you say, no wonder the stock market's gone vertical for a dozen years. It's a zero, and for 10, 12 years, no wonder the stock market was inflated. We've had inflation for many years. It just didn't go into commodities until when asset managers again did what? Change their preferences from stocks to undervalued commodities that have less risk, probably more reward. And sure enough, that's what's happening. So now we have what the public and the Fed call inflation. In fact, we've had it all along. It's just been expressed elsewhere in a vertical stock market. So I think that bubble's going to burst. Not that the flow of money from the Fed or the ECB or the BOJ is going to stop. It's just going to go elsewhere because people aren't going to put it where the Fed would like them to put it. Now, what's the central bank going to do when the debt markets they must defend are breaking down? Are they going to taper? Are they going to raise rates? I think not. And I think gold knows this. Basically the central banks of the West are caught in a historical dilemma of their own creation. And they're going down the swirly along with their policies. And I think they're going down the swirly this year. Where will money want to go? It's been said cash is trash. Major asset fund manager said that some months ago, and he's dead right, and he's not even a gold bug. So I think the public is getting aware of this. And then we go to another interesting issue that's been debated on a lot of the financial channels lately. In fact, I saw something today on it. Bitcoin or gold? Well, we measure them both, but we've been watching the spread relationship between the cryptos especially Bitcoin and gold, and Bitcoin and silver. Because our bet's on silver. We think silver's going to vastly outperform gold. I think silver's going to leave gold behind on a percentage basis. But that spread is measurable, meaning the spread relationship of the valuation of Bitcoin versus silver. Well, clearly over the last, since Bitcoin's been around, this is a baby. It's only been around half dozen years or more. It's thrashing. People can't quite put a valuation on it. But it has definitely beat gold and silver in an irregular manner, but in an upside manner. Very violent, just like its price has been. Those charts to us look vulnerable. In other words, it looks like we could be nearing a point where Bitcoin, on a valuation basis, relative basis, could top out versus gold and silver, and that they could replace it as the place where people are putting their money for safety reasons. And it wouldn't surprise us to the effect that, okay, the shift has occurred. It's time now to shift out of Bitcoin and into gold and or silver, preferably silver. Now, that doesn't mean Bitcoin's got to go down. It just means that Bitcoin will shift relative performance such that silver will beat it going forward. And I think that's about to happen. Ultimately, this time, I don't think there's a way out. And by that, I mean, you're not going to end with policy working or a Volcker comes in and ends it, and just puts the brakes on and stops the process. Of course, then you went down. We all know that once that happened. The stock market was a wasteland from about 1977 through 1982 at least. While gold and commodities outperformed it. But this time I think it's more, meaning I think at the end of this next crisis, and I think we're headed for one, not just in pricing, but in that, you're going to have people raise the question, it's been 50 years of this stuff since that Republican Nixon took us off the gold standard, international exchange basis of the dollar. And we've had nothing but fiat currencies in Europe, here, and Japan since then. It hasn't worked. And we think we've been under control, had a policy and all this nonsense. And it's just been a boom-bust cycle, getting worse and worse each time. And it wouldn't shock me, what a world this is to say this, that the ex-communist countries of the world have gold-backed currencies before we do and set the new trend. And I think that's likely to happen, where we end up with stable currencies. It could be crypto. Crypto at least can't be hyperinflated. It can be expanded somewhat year to year as they find more, et cetera. But it can't be, double the money supply every year like the central banks can do. So it's going to be an interesting year. And I think the markets are going to create what I call a swirly. And that swirly will affect not just markets, but people. It's hard to predict these things, but I think the trend is pretty evident. And we know that the wave effects will create all kinds of unusual outcomes that a lot of people can't, it's not on the tip of their tongue right now. Political events, social events, and so forth that perceived to be traumatic, but actually will be healing. Because if you get rid of something bad and it makes some noise while you're getting rid of it, that's the way it works sometimes.
The financial landscape is at a turning point, with major asset managers and hedge funds reassessing their strategies amidst overvalued stock markets and growing risks of a downturn. Concerns about prolonged steep market trends, reliance on a few leading stocks, and unsustainable monetary policies are driving some smart money into safer assets like gold, silver, and treasury bonds. Gold and silver are viewed as undervalued havens poised to outperform, with silver expected to outshine gold on a percentage basis. Meanwhile, Bitcoin's dominance as a speculative safe asset may be waning, with funds likely shifting toward precious metals. Central banks, caught in a policy dilemma, struggle to maintain stability, potentially amplifying the shift away from fiat currencies toward assets with inherent value. This period could lead to significant market corrections, geopolitical changes, and a reevaluation of global monetary systems, with ex-communist countries potentially adopting gold-backed currencies first. The shift could trigger economic and societal transformations, ultimately paving the way for a more stable financial order.